The fund or the sector that gave you the best return last year is probably the worst place for your money right now. The top performer often becomes the bottom performer. And this is not guesswork. This is data-backed investing. In this video, I will show you exactly why buy and hold might be costing you money rather than making, and how a simple tactical switching strategy can beat most investors who do nothing. The Nifty Small Cap Index had maximum loss this calendar year of minus 25% from the peak. But guess what? Just last year, it delivered plus 27% return, nearly 3x more than Nifty 50, which returned only 10% in the same period. And yet, Nifty 50 had a drawdown of only 7% this year. What does this tell us? It tells us what worked last year will punish you this year. And unless you're switching tactically, trading your profits, you might be riding the winners too late and holding on to the losers too long. So if a fund category or market cap segment has delivered strong returns, especially for 2 consecutive years, staying invested in it blindly can lead to losing back much of the gains. Imagine making 40% in 2 years and then losing 20% in the third. That's because outperformance often leads to overvaluation and the market tends to rotate to undervalued segments. So next, tactical switching, where you gradually move profits from recent winners into stocks that are underperforming or out of favor. This can help you not only protect the past gains, but also put you in an asset that is ready for the next bounce. So this is not about timing the market perfectly, but it is about respecting market cycles and avoiding what we call the mean reversion traps. We will understand how stocks and indices rotations work. I'll show you real data behind these sharp reversals, and most importantly, how to use this pattern to position yourself for the year ahead without having to chase the past winners. Watch till the very end because I will show you how to identify sectors before they outperform. So this is not a trend, it is a rotation that you need to ride. So in section 1, we will deal with the rotation trap. Let me show you something which is very fascinating when I first saw. This looks like too much data, but do not worry. I'm going to make it very simple for you. Now we are moving from right to left, that is year 2007 onwards to recent. Returns per calendar year, returns of funds such as large cap, mid cap, small cap, various factors such as value, quality funds, returns of sector funds such as finance, private banks, defense, commodities, oil and gas, etc. So just look at the colors. Dark green indicates that index or the sector has done very well in that particular year mentioned above. Now, if you see a fund that has done very well, dark green, consecutively for 2 years, you will see that it is followed by a red indicating that some profits has been lost back to the market. For example, you had 200% return in this period for microcap index, but if you held on, you lost back 50% back into the market the next 2 years. In small cap, you would have made 58%, but you lost 33% next 2 years if you held on. You can see that the trend across, if dark green, then they are followed by red. So the point, most people invest after a rally, but historically, if an index performs well for 2 years, the third year is flat or negative, generally speaking. That's the rotation trap. This is an approximation to convey the sense. So if your fund is up 80% in 2 years, there is no reason to add more. It is rather a signal to rebalance. In the second section, let us see how sector rotation has become faster. Take a look at this chart. Utilities gave a staggering 50% return in just 6 months, but immediately after that, they fell 14% in the next 6 months. You will see similar swings in IT returns, 17% in 6 months, followed by minus 80% loss. Energy 25%, you continue to hold, you lost 17%. Real estate, big returns followed by big losses. This chart makes one thing very clear. Multi-year trends are dead. What we are seeing now is 6 months, 12 months, 18 months rotation. Sectors rise sharply, they peak and they fall just as fast. In this kind of a market, the traditional buy and hold, buy and forget strategy is not working anymore. If you hold a sector or a stock too long, you risk holding on to yesterday's winners and they often become today's losers. Flexicap funds are designed to handle this in principle. They're allowed to switch between large cap, mid cap, and small cap dynamically. They can switch between sectors they feel that is right. In theory, they should help you stay with what is working. But here is the problem. Not all Flexicap funds use that flexibility. They actually stick close to benchmarks, avoiding bold moves so that they don't underperform or they don't look too risky. So if you want a fund that can truly ride sector rotations, look for these two things. Check that in their portfolio of a Flexicap fund before you choose. 1. High turnover ratio. This goes completely against conventional wisdom. This means the fund manager is actively rotating the portfolio based on market shifts, but this should result in higher than benchmark returns. So the intent must be verified with the results. So there has to be two checkpoints. Just high turnover ratio is not good enough. Has the fund demonstrated high returns? Is the fund able to demonstrate that it has used high churn to actively rotate and outperform the average? Second point is high active share. This tells you how different the portfolio is from the index. Active share measures how different a mutual fund's portfolio is from its benchmark index. A score of 0 means it is identical to the index. A score of 100 means it is completely different. Now, why does it matter to you? In a market where sector rotations are rapid, a high active share means the fund is truly making independent decisions, not just mirroring the index. That's critical today because if your fund looks too much like the index, you will suffer the same drawdowns, but you are paying more fees. So, when the returns rotate fast, you want a fund with high active share. It shows the fund manager is willing to move away from what is no longer working. There is a misconception that high turnover is bad, but in mutual funds, you are not paying taxes for their internal transactions. So why glorify low turnover in a world where sector cycles are shrinking? In fact, funds with a higher active share and dynamic allocation style, they actually tend to outperform in this new regime because they are willing to switch lanes when the road ahead has already changed. So, no, you don't need to time sectors on your own, but you do need a fund that is willing to do it for you. And that means investing in a fund with very active management, not that is index hugging. Earlier, you could ride a trend or a sector slowly, predictably, profitably over a long time. But now the change is faster. If you don't move with it, you will be left holding to what has done well in the past. The market does not reward patience the way it used to. It rewards adaptability. It isn't about market timing. It is about timing your rebalance. So set up a 6 months or a 12-month portfolio review cycle. If you are skewed to sector funds, ask which sector did well, which lagged, and don't react emotionally, just rotate tactically. Of course, you're starting your journey, then you will need professional help till you come up to speed with knowledge. So let's simplify this with a rule anyone can follow. Let's call it the 2x1 rule. If a sector or an index outperforms for 2 years, cut a percentage allocation. Do not act in extremes as the rally may continue longer than you anticipate. The idea is to be prepared rather than predict. You will have to take into account taxation and other charges and then consider the opportunity cost of shifting versus not shifting. Rotate capital into sectors that is in the bottom 3 of the past year. Repeat this regularly. Example, Nifty IT was at the top in 2020 and 21. Then it crashed. Now Realty gave a huge return in 21. Then it corrected in 22. PSU banks underperformed through 19 and 20, followed by huge returns in 2021 and 22. FMCG has underperformed for years, which means less downside, better protection. There are now also smart beta funds that tries to combine multiple factors. This is worth reading up and evaluate. Evaluate if you need to include them in your portfolio. A factor-based fund like say low volatility or quality focused funds to reduce your risk. People hate switching because they fear missing out, but not switching when the data tells you to, that's what really causes regret. Now, you may ask me, I invest through SIPs. Does this apply to you? And the answer is yes. So it's about smart SIPs and tactical mindset. Continue your SIP in the core diversified funds. Add one tactical fund. Rebalance your allocation every 12 months or so based on these rotation trends that we discussed. For example, Nifty Equal Weight or Nifty Next 50 SIP outperformed traditional Nifty 50. Over 5 years, these strategies had lesser downside and better recovery. You don't need to predict the market. You just need to respond to what it is already telling you today. This isn't just gut feeling. This is a serious research behind it. In 2025, buy and hold is not enough. You need to buy, watch and switch. The winner of 23 already lost in 24. The winners of 25, they are still undervalued, ignored, but quietly climbing. So don't get caught in yesterday's heroes. Be ahead of the curve. I hope you liked this video. If so, please hit the like button, share it with your friends and subscribe to this channel.